Welcome to the Impact Webcast series on growing a business. I'm Dr. Cindy Mencius, the Impact Director of Contractor Training and Development. The goal of the webcast series on growing a business is to provide our contractors with information, tools, and resources that they can use to grow and improve their business. Today's important webcast subject is company transfer and succession strategies, and our presentation topic is selling your business to your employees, employee stock ownership plans as a succession strategy for business owners. Our instructors are Dr. Christopher Mackin of Ownership Associates and Attorney Terry Jones of Maslin & Jones, both from the Boston metro area. Dr. Mackin serves as a strategic advisor to companies owned primarily by their employees, and Mr. Jones has helped clients navigate the business life cycle, including business succession planning, tax, and estate planning. Thank you for addressing our Impact members today.
Thank you.
Thank you, Cindy. I'm Chris Mackin from Ownership Associates, and I wear a couple of hats here. Ownership Associates is the primary one. I come to the Impact Ironworkers group from having met members of the ironworkers who have been students at the Harvard Trade Union program at the Harvard Law School, where I teach on these topics. And another group we'll be talking about at the end of our session is American Working Capital, which is an investment banking group that can help on the feasibility side of this. I'm talking to you primarily as Ownership Associates. And this is our agenda. Cindy's done the introductions. I'm going to do a background on the ESOP concept that people may have heard of in the general business press and from their experience in their communities. I'm going to sort of give a little color on what it is. We're then going to talk about some caveats for today's session. The purpose of the caveat segment is to make clear who this content is addressed to. This is not a one-size-fit-all kind of a idea or a solution. This is an idea that we're focused on today on probably the larger size fabricator employers and employers that are in a healthy economic condition. But we're going to talk more about the caveats, about what this, who we're addressing here today. Terry and I will talk about that. And then Terry will go into detail, my colleague Terry Jones will go into detail as explaining how ESOPs work. He'll then turn it back over to me, and I will talk a little bit about how ESOPs look from the shop floor. What does it mean to have a company that is owned by its employees? We'll then have questions with Cindy and talk about next steps if people are interested. The learning objectives. What do we hope you're going to get from coming out of this session? We're hoping you're going to understand, where did ESOPs come from? Where does this idea come from in the first place? How do ESOPs work? Is my company large enough for an ESOP? What do employees think of ESOPs? And what steps should I take to investigate this idea further? So what is this notion? What does ESOP stand for? Well, as the slide tells us, it stands for Employee Stock Ownership Plan. And in the best of circumstances, where things are working well, it is a company where everybody is a stakeholder and people feel motivated as a result of that. And the companies that have become employee-owned, by and large, have been success stories where people feel proud. As you see with the sign, a company that's owned and operated by our employees, that can make a difference in the marketplace. There are close to 7,000 of these companies all around the country. They're in every industry group. They have been, as we'll see in a minute, it's been an idea that's been around since the mid-'70s, and it is spread across different industry concentrations, which I think we have here on the next slide. I've picked out some of the larger companies in the middle of the slide here, in the construction and engineering sector that people will likely have heard of, just so you can associate this idea with companies you know. Parsons Construction, Chinbro up in Maine, Austin Industries in Texas, McCarthy Building in St. Louis, and Hensel Phelps in Colorado. On the engineering side, CH2M Hill in Colorado, Black & Veatch in Kansas is a long-time ESOP companies. These are Kleinfelder in San Diego. These are companies that if you've likely heard of, or you could make a few phone calls and ask people how it's going. The other major industry groups, these are really the four major industry groups that the 7,000 ESOPs concentrate in. You've got manufacturing, and you've got a lot in supermarkets. The Publix supermarket chain in Florida is the largest of all of the ESOPs in the country. It's a combination, actually, of a profit-sharing plan that owns employer stock and an ESOP. Price Chopper and Winco Foods are two others. In Chicago, the largest manufacturing ESOP is Amstead Industries. They manufacture railroad cars and the undercarriage of railroad cars. W.L. Gore, the maker of Gore-Tex, the fabric, is a very successful large ESOP company, and Kruger Furniture in Green Bay, Wisconsin. ESOPs, where do they come from? Well, guess what? They were invented by politicians. As you'll be learning more in this session, this is a structure that comes to us via retirement law, benefit law. It's actually, in a way, it's a cousin to a 401k. It's older than a 401k in terms of a concept, but it's a defined contribution plan that invests primarily in employer stock. And it was this gentleman, Senator Russell Long, the son of Huey Long, the famous Louisiana politician, who decided this was a good idea that would help American competitiveness and productivity and would break down some of the problems of inequality that Senator Long was speaking about in the 70s and 80s, which in many ways have gotten worse in this country. And so one of the reasons why ESOPs are experiencing something of a resurgence is that people are looking for new ideas in the business world that help share the wealth. And that's part of what ESOPs do, is share the wealth. How does it work? How do we talk about the idea of employee ownership? Because it's a little bit counterintuitive initially. Those companies, those 7,000 companies that I had on the prior slide, are not companies where employees have reached into their pockets to buy firms. Senator Long recognized from the start that if we're going to try to engineer a participation in ownership, that we had to deal with that basic fact that workers don't have the money to buy out shares, but the workers can have the federal government as a partner to help make this happen. It has the federal government as a partner in terms of the tax laws that provide incentives for business owners to sell to the employees, therefore fulfilling the public policy objectives that Senator Long had. And so a little bit of how this works. So Senator Long had four primary insights. He said that capitalism is an overly exclusive club. He said we need more capitalists. The second insight is that working people do not have adequate capital to buy the business. So how are we going to solve that? Well, point 3, the federal government should make it possible for working people to borrow through an employee stock ownership trust. It's a very specific form of a legal trust, and that trust, with the cooperation of the seller and the owner, who has to be persuaded that this is something in his or her interest, and we're going to talk more about that, the ESOT, representing the employees, can go to the bank to borrow funds to purchase these companies. That's the essential core of this idea, is that there's a trust representing people who otherwise wouldn't be capital participants. The market opportunity for ESOPs is generally focused in the range of companies between 10 million in sales and 500 million in sales. These are closely held companies. They're privately held companies. We will be talking today a little bit in a minute about the caveats here. The companies that are presumably watching this are maybe in that first group, maybe even a little bit smaller than that. But this is generally where they're happening. They're happening because the business owners have reached a retirement age and are looking for a solution to get liquid to be able to cash in decades of hard work. And those business owners may be persuaded by Senator Long's proposition here that selling to a legal trust representing their employees is a good way to exit, to preserve the jobs, and to reward the seller with a fair market value for what his or her company is worth. How do these companies work? Well, this is a slide from a group called the National Center for Employee Ownership, which is based in Oakland, California. I'd recommend nceo.org. People spend time on that website. They have conducted research or worked with academics at Rutgers University and Harvard University and various places around the country and done studies that show that productivity improves by 4 to 5% on average in the year an ESOP is adopted. And over a 10-year period, ESOPs have a 25% higher job growth than comparable companies without an ESOP. So what's going on here? People are feeling different about their work if they are co-owners of that work, if they're participants in ownership. And the key to this, as we'll get into at the very end of the session today, is how ownership is communicated and how people are made to feel included while preserving clear management structures and authority structures to run companies in a professional way. And we'll talk about the balance and the trade-offs of how to do that at the end. Another slide talking about some studies that have been done. The return on assets of 2.7% greater than companies that are without ESOPs. ESOPs increase sales by 2.3 to 2.4% per year. Details of those studies can be found at the NCEO webpage. Finally, as I mentioned, ESOPs are a form of defined contribution plan, and their cousin is the well-known 401k plan, which invests in diversified shares of, usually through mutual funds, of stocks of companies around the country. Now, 2 points to make here. One is the best practice as accepted in the ESOP community is that employers should have, if they're going to have an ESOP, they should also have a 401k plan as a supplemental plan. Or in the best of circumstances, and I think we're talking about that in part here, they should be participating in a defined benefit plan. You don't want to have all your retirement assets tied up in the stock of just your employer. However, that idea is clearly a very good one. The average rate of return over a 15-year period from 96 to 2010 was 6.9% for ESOPs versus 5.8% for 401k plans. This obviously covers the period of the financial recession, and you can see that people you really can't do much to influence the return of your 401k plan. Workers and managers can influence what goes on within the four walls of their business, and that's evident in this kind of data. But the general principle of having some diversification of retirement assets still holds. ESOP should not be the only retirement vehicle. There should be other vehicles as well. And I think I'm going to pass this over next. We're going to back up, and I'm going to introduce my partner Terry Jones, and we're going to talk a little bit about who this session is geared to, and some caveats before we get into the weeds and into the details of the technical side. Terry, do you want to lead off with this?
Yes, thank you, Chris. And obviously there are some situations that fall outside of these 7 characteristics, but if we had to look at an ideal situation for a company that might want to consider an ESOP as a succession tool, this is what we would ideally like to see. And first of all, obviously, we'd like to see a profitable company, a company that's not on a downward trend either because of the way it operates or because of economic factors outside of its control. We'd also like to see a company that has relatively steady earnings. Obviously, we'd like to have the earnings increasing over the years, but it's difficult if we have a company that has wild swings in earnings because the appraiser is going to have a very difficult job maintaining value, and one of the implications of that is from the employee's standpoint, if they see that their ESOP account is fluctuating or going down from one year to the next, it becomes something, it's a disincentive in some cases. The third issue, third characteristic that we look at is, are the ESOP advantages, the tax issues that we're going to look at later, large enough to justify the transaction cost? Because we don't want to mislead people. This is not it's not a very cost-free or low-cost option for business succession. But one of the things that you need to take into consideration is, if you're looking at an alternative structure like a third-party sale, you're probably going to have to pay a business broker, and that can run 5%, 10%. So, but the transaction costs for putting in an ESOP are not insubstantial. So we're suggesting, if you're looking at it seriously at an ESOP, probably look at a first tranche of $1 million plus. There are some smaller,
Okay, and you might want to just describe a little bit what you mean by first tranche here.
Okay.
In terms of,
Ideally, we like to have ESOP companies that are owned 100% by the ESOP, but it's very common to have stages of ownership.
Right.
We might, for example, when we talk about 1042 later, we want to have a minimum of 30%, but there are other situations where we'll go 10% a year and then ratchet up. There may be some situations where the ESOP is never going to own 100%,
Right.
and that's fine. That's part of the whole discussion at the beginning during the feasibility. What's the ultimate objective?
Right. Okay.
The next characteristic is, obviously we need to have sufficient cash flow generated in the business to pay off the bank if we're putting in some bank financing, and also to pay the owner for the shares. Next, we need to make sure we have enough employees really to create a base both for contributions. We have a 25% of compensation limit, which we'll get into later. And we also, if we have very small ESOP companies that are S corporations, we run into some very stringent anti-abuse rules that are very difficult to get around it. So we typically say, if you're looking seriously at an ESOP, figure on maybe 25 employees or more.
Minimum. And if I could just stop there for a second, that one of the things that we've spoken to Cindy about and to alert the audience to is that we recognize that Impact has a lot of members on both the contractor and the fabricator side that are in that 25 and lower phase. And there are another set of possible solutions here that don't necessarily involve the full ESOP idea that we're talking to Impact about, and we're considering doing another session that is going to be specializing on the smaller employers. But we want to focus this session on at least the 25 and up. And one other just qualification, this I think will be clear, is that there are two kinds of ESOPs that Terry just referred to. There are ESOPs that are taking out loans to be able to buy substantial chunks of stock. That's a leveraged ESOP. And there's non-leveraged ESOPs where an employer just decides to get started on this road and introduces an ESOP like a 401k, he or she would a 401k plan, where they could begin to contribute stock on an annual basis lower amounts. The focus of this session today is more on the leveraged ESOPs, I think. We're really talking about getting people to understand this as an exit strategy and not just an additional new benefit that they might want to add into.
Sure.
Okay.
And then the last characteristic, which is really something that Chris is passionate about and will have a fair amount to say about, is the company culture and the management shop floor relations. They have to be right.
All right.
We never want to put an ESOP in a situation where it's just not going to work.
That's right. Well, and if I could on that real quick, we're both excited that this is a labor management association that's brought us together here, and that we have union and management involvement. And I think that there's every reason to believe that this can be worked out and that union members can be participants in these. That's a little bit easier on the fabricating side than it's going to be on the contractor side of this industry. So we're going to, but the fact that there is an Impact association to begin with, that you have a labor management cooperation structure, bodes well for the idea of having successful employee ownership, and I'm going to talk more about that later.
And we have a track record in having done ESOPs in those situations where they've worked out very nicely.
That's right, for unions and
Sure.
management. Yep.
Very good.
Yep. You're on.
Okay, so this part of the presentation is, I'll go into some of the technical detail. I'm trying not to get overly technical, but I think it's important to understand some of the basic excuse me, concepts. And I want to start out just by talking about what's the environment that faces an owner who's looking for succession. So I'll spend a little bit of time on that. We'll talk about what is the legal definition and the tax definition of an ESOP. What are some of the operational rules that we have to be concerned about? What are some typical transaction structures if an owner is looking to exit? And then I'll talk a little bit about some of the tax incentives. So, as a business owner, there are some obstacles that have to be confronted, and Chris has already mentioned too much of the owner's assets are often tied up in the company. When they're looking to transition, they need to get liquid because they need something to replace the income they've been earning as someone who's been active in the business. So this is a very typical problem. Second, even though an owner might want to sell to the employees directly, oftentimes the business is just worth too much to structure a management buyout. Either the managers don't have the assets or they can't go to the bank and borrow. If an owner wants to go sell to an outsider, those are not always attractive situations. They may look attractive at the beginning, but I've seen lots of third-party sales that have been structured. They get half the payment in cash. They may take a term note, and they may take an earn-out as part of the deferred payment. If the new buyer, if the new owner doesn't run the business properly, they may end up with just the cash. I tell owners, if you're selling, the only part that's going to be guaranteed is the cash, and that may also be subject to escrows. It may be subject to indemnity claims. So don't count on anything else. It may be great. We've certainly had them where the note gets paid off, the earn-out gets earned, but we've also seen situations where that doesn't happen. The other factor is a third-party sale can often result in a loss of control. The owner may just want to buy out the competition. They may want to shut down the operation just to keep it from being in competition. And many owners really feel they've built up this business with the help of the employees, and they don't want to leave the employees stranded. So we have lots of owner clients now that are really concerned about preserving a legacy. The other issue that sometimes comes up, if you have more than one owner, you may have stockholders who are in a different path within their personal financial lives. Mm-hmm. Some may want to be cashed out, some may not want to be. So a third-party sale would, buyers want to buy 100%. In most cases, they don't want to do a partial sale. So third-party sale may not work in those situations. And obviously, even if they decide they want to do a third-party sale, there may be no buyers. If the stock market goes down, if the economy is in a recession, M&A dries up. There aren't any buyers. People are not going to take a risk of buying a business. And I've already mentioned, if you sell to a third party, there's going to be some residual liability sitting there. If you try to do something like a merger or a strategic partnering with a business, those can be risky. You can lose the control. They can be expensive to implement, so they may not work. So ESOPs really, we think they make sense in a lot of these situations as an alternative. And, first of all, unlike a third-party sale, they can be staged over several years. You can start with the first tranche of maybe 30%. We've done them where the owner, right from day one, says, I eventually want this ESOP to own 100%, and I'm going to stage it in 3 pieces. We'll do 30%, 30%, and then 40%. Right. So ultimately there is 100% ownership. If we have multiple owners, multiple shareholders, it's very common for one owner to go ahead and sell to the ESOP, the other one stay in. We did one succession a few years back where one of the owners definitely wanted to be out. The other owner was a little bit younger, felt that the business really could be grown. Ultimately, it probably made sense for the business to be sold in a consolidation, but that was a perfect situation where one owner was bought out with the ESOP, the other one stayed in, ran the company. ESOPs, unlike a lot of other third-party buyouts where the buyer may want the owner just to sail off into the sunset, the seller can retain a role in management. Particularly in a partial sale situation, they may want the ESOP wants the owner to stay there and continue to contribute. And obviously, the next bullet, employees can gain a stake in the company. I mean, that's why we're here. Employees are engaged. I was up yesterday at the annual meeting for a client, and the CFO told me, he said, he's relatively new in the job, a couple years, and he said, there's a real energy around this place. And he was from the public accounting world, and he's new to the ESOP, and it was really gratifying for me to hear him say that because, he didn't know about ESOPs that much before he went into this job, and I felt it too. The employees were all smiling and happy, and it's great. And then finally, the tax benefits associated with ESOPs can make a sale feasible compared to an after-tax purchase. So, I never want to say that the tax should drive the transaction, but it's certainly nice to know that it makes it much more feasible. Okay, so we've been throwing around this word ESOP, and Chris told you a little bit of the background. I just want to elaborate a little bit. First of all, it is what we call a tax-qualified retirement plan. What that means is it has to meet very specific rules under the Internal Revenue Code, or the IRC, in order to get the tax benefits that I'll talk about later. It is also regulated by the Department of Labor. ERISA, which stands for Employee Retirement Income Security Act of 1974, contains both tax code provisions and also what are called the labor provisions. So it really has joint regulation between Department of Labor and the Internal Revenue Code. Labor is much more concerned with the issues of stock valuation, making sure that the ESOP doesn't pay too much for the shares, making sure that the people who are called fiduciaries who are running the ESOP are doing the right things. Really, they have a statutory duty to act solely in the interests of the participants and beneficiaries, so that they may not be conflicted. And one of the things Chris will mention later is in the issue of who should be the trustee, making sure that the trustee is free from conflicts of interest, because they have a very stringent statutory duty to act solely in the interest of the participants and beneficiaries. Because ESOPs are tax-qualified plans, they have some of the characteristics of a 401k plan or a profit-sharing plan. This is a broad-based participation vehicle. It's not something where we can select a group of employees to participate. As I'll explain the participation rules, this is broad-based ownership, as Corey Rosen likes to say. It's designed specifically to invest primarily in company stock, which meets the definition of qualifying employer security. So it has to be stock that has the highest dividend rights, the highest voting rights in a company. ESOPs are allowed to borrow money, as we'll see, and that includes borrowing from the company or the selling shareholder, and that's unusual. Usually most retirement plans are very strictly limited in the types of transactions they can enter into with a related party. I had a profit-sharing client many years ago that was getting 3 or 4% on its assets, and the company needed some capital for operations. And I got a call from the president. He said, "Well, we're willing to pay more than the profit-sharing plan is getting right now on its assets, and the company could use $1 million to fund some operations." And I said, you can't do it. That's what's called a prohibited transaction. Even though it seems like it's working in favor of the employees, it is strictly prohibited. ESOPs, as we'll see, have a whole separate set of rules that allow those types of things to happen. Lastly, ESOPs can be funded with contributions of stock, what we refer to as in-kind contributions. Operationally, they look very much like profit-sharing plans or 401k plans with respect to who gets to participate. The minimum statutory rules are anyone who reaches age 21 and who has 1,000 hours in a one-year period is eligible to participate. So that's essentially 20 hours a week.
Right, and if I might, that's an important thing to emphasize in terms of the seller can't pick who is in the ESOP. This is a federal plan that is designed to be available to all employees.
Right. Yeah. I mean, in some situations you can have classifications that are excluded, but if they meet those statutory requirements, you can potentially run into some discrimination problems if you're keeping people out. So we tell people, this is a broad-based plan. The concept of vesting, basically involves situations where people leave prior to retirement. What do they actually get to take? What do they get paid on if they leave? And the concept of vesting is the typical vesting is the statutory minimum, which is the 6 years, 20% after 2 years, and then 20% a year for the remaining 5 years. So full vesting at 6 years. That can be done faster, but that's what the law requires at a minimum. One of the issues we run into with new ESOPs is, okay, we're putting in a new plan, we're putting in a new program. How about the people who have been with us for 20 years? Do we want to give full credit for prior service? We don't have to. Some ESOPs give partial credit, some give full credit. To a certain degree, there are two issues. First of all, is we want to retain people. We want to keep them there. We want to have them have an incentive to stick around. And the second one is a cost issue. If you have if everyone's immediately vested and if they leave, it's going to cost more to buy their shares back. So those are all issues that go into the feasibility. In terms of how the contributions to the ESOP get allocated, most common is just in proportion to compensation, but we can layer in, if we want to, we can layer in a points-based allocation that gives some credit for how long you've been there, how much you make.
And again, if I could just jump in here for a second, these are like the dials that you turn when you design your ESOP in the first place. And in a healthy labor management environment where the employees, shop floor and office employees become part owners, it's a healthy thing to have a discussion of these things. So,
and again, remember, you got two groups of employees. You got the people who are there now and the people who are going to be there in the future. So, to a certain degree, their interests can be a little bit different.
Yep.
ESOPs, unlike traditional profit sharing or 401k plans, have different rules, and most of these rules are actually very, very much pro-ESOP. The first is the investment of the assets. ESOPs have a specific statutory permission to invest up to 100% of their assets in company stock. Now, there are some court cases that have come down that open the door a little bit for calling that into question. But generally speaking, if it's a healthy company, trustees really have the ability to invest up to 100% of their assets in company stock. As I've already mentioned, very broad statutory relief for related party transactions. The owner, who would normally be one of the people who's called a disqualified party or a disqualified person, is able to sell directly to an ESOP. So that's not something that trips us up. The owner is also able effectively to lend money to the ESOP by what we call seller financing, which I'll get into. Distributions are treated a little differently. We have a whole set of rules that are designed basically to let employees who have been there for 10 years, who have participated for 10 years, and who are nearing retirement, they're allowed to have the company transfer, have the ESOP transfer a portion of their interest out of company stock into other investments. It starts off at 25%, 5 years later it goes to 50%. I can tell you in our experience, many ESOPs that have offer diversification to employees say, you know, I'm very happy with what the ESOP has done. I'm making a better return on my investment within the ESOP than I would in the 401k plan if that was my diversification tool. So they'll stick around. If the ESOP does distribute shares upon retirement or termination, the employees have what's called a put option. They have a right to force the company to buy the stock back. The ESOP can step in and honor the put, but the company is actually the party that has the legal obligation to buy it back. With respect to voting, and Chris will talk at length about this when we talk about the governance piece, ESOP participants have a basic right to direct the trustee on major shareholder actions. And this would be merger, consolidation, sale of substantially all the assets, liquidation. There may be one that I've missed, but in general, we like to see ESOPs that go beyond that, but at least those are the minimums that Russell Long and his progeny
All right, we'll
built
talk
into
more
the law.
about that. Yep.
Okay, so some of the transactions that might take place. First of all is the non-leveraged cash contribution. Company contributes cash. Cash is used by the ESOP trustee to buy the shares from the owner. Very simple. Owner gets cash. Could result in capital gain, as will gain to the seller, possibility of deferral under 1042, as we'll see. Non-leveraged, a non-cash contribution. Company could simply issue more shares and make a contribution to the ESOP in shares. The difference there is the shareholders are diluted. They don't, excuse me, they don't end up with any money in their pocket as a result of that, but the ESOP ends up with an ownership interest. Now, when we start talking about leveraged, if you just follow...
Explain the term leverage.
Leverage is another fancy word for borrowing, okay?
Right.
Okay. And basically what we're doing here is we have a two-step leverage here. We have, as I'll explain, an inside loan and an outside loan. The outside loan is step one on the lower left there. The bank, once the feasibility study is done, the bank says, okay, we're happy to lend money to this company for the purpose of instituting this ESOP. So they lend money to the company. That's the outside loan. The company then turns around in step two on the lower right, lends money to the ESOP, the loan proceeds, and the ESOP in step three buys the shares from the seller with the loan proceeds. Step 3A, and the owner sells the shares to the ESOP. Step number 4, in order to make the payments on the bank loan, the company contributes annually to the ESOP, and the ESOP makes payments back up to the company in order to service the debt. This is just a summation. You can go back to this later, but it basically...
what you just said.
It's basically what I just said, and since we have a lot to go through here, I won't repeat it. What happens, what does the ESOP look like inside after the ESOP loan closing? Well, on day one, just same as if you go out and buy a house and have a mortgage for the entire purchase price on day one, the ESOP owes the amount of the purchase price back to the company, and the company has received a pledge of the shares back from the ESOP. So effectively, the shares are still held in what's called a suspense account. Within the ESOP, there are participant accounts that are established. So it's a bookkeeping account. As Chris will explain, it's not true direct ownership, but the participant has an account that shows a number of shares assigned to that account. Those shares are held in a suspense account until the loan gets paid off. So on day one, assuming 100% leveraged ESOP, all of the shares are in the suspense account, so nothing is released. In future years, The company is making annual contributions to the ESOP, and the ESOP is taking that money and using it to make a loan payment for that year. And in step number 3, as the loan payment is made by the ESOP, the company is going to release a portion of the shares from the pledge. And once that happens in step 4 on the lower right, the ESOP is going to allocate the released shares to the participant accounts. And those will be released under the ESOP allocation formula. And the one we illustrated here is just compensation-based allocations. Now, supposing there is no bank, supposing the seller says, I don't really want to go to a bank, I'm happy to just go ahead and have the ESOP give me a promissory note for the purchase price. Under this circumstance, the situation, the seller enters into the purchase agreement with the ESOP. ESOP gives a note to the seller. ESOP, with the note, buys the shares. And then each year, the company contributes to the ESOP the amount necessary to pay the seller on the note. And the same thing is going to happen inside the ESOP afterwards. Day 1, everything's going to be tied up in the suspense account. And then in future years, as the company makes the annual contributions to pay off the seller note, the seller is going to release a portion of those shares from the pledge, and they'll be allocated inside the ESOP to the participant accounts. Now let's, again, I don't want to overstate, I don't want to suggest that ESOPs are only tax motivated, but the tax incentives are very real and something that I think owners are interested in. And first of all, from the employee's standpoint, unlike true ownership, employees are not taxed until they actually receive a distribution from the ESOP, so there is tax deferral. And this is very important. In fact, when they receive their distributions, they can elect generally to defer the tax by rolling over to another qualified plan or to an IRA. The company, by the same token, gets to deduct contributions even though those amounts haven't been they haven't been distributed. So it's employee gets a deferral, the employee and the employer, the company gets an immediate deduction. The seller may gets capital gain treatment generally on the sale. And if it's a C corporation, as we'll see, there's an ability under what's called Section 1042 for further deferral. Very importantly, the trust agreement, the trust that holds the shares is tax exempt under the tax rules. Therefore, it doesn't pay any tax on any earnings within the trust. And if an S corporation is owned 100% by an ESOP, it essentially escapes all federal income tax. States vary, but this is a very significant potential tax savings. And S corporation 100% ESOPs are very popular these days. 1042, I'm just going to say a few words about this. We have a lot to cover. This is very attractive for C corporations where owners typically have a very low basis. If they've sold their shares, essentially 100% of it would be taxed as capital gains. Capital gain rates are not insubstantial. They start at 20%. There's a 3.8% add-on. What we're able to do under 1042 essentially is avoid all the capital, defer the capital gain tax. And if the qualified replacement property is held until death, they can actually avoid the capital gain tax altogether. So there are some technical requirements. Only applies to C corporations, only applies to individuals. Seller has to have owned the shares for at least 3 years, which in most cases isn't a problem. The ESOP has to own at least 30% after the sale, and then the seller has 1 year after the sale to invest in what's called qualified replacement property. There are also restrictions. Obviously, the seller can't take the deferral and then participate in the ESOP, and the seller and the family. Qualified replacement property is basically stock or bonds of U.S. companies. You can't use mutual funds. You can't use CDs. couple strategies, what's being marketed, because once the QRP is sold, it's going to trigger
Qualified
gain.
replacement property.
Qualified replacement property. Once it's sold, the owner's going to be taxed. So there is a fairly active market for what's called floating rate notes. These are long-term U.S. company bonds. They pay a low rate of interest, but they can be held basically. And one strategy that some people push is an active strategy where you actually borrow against the bonds within the account. So it's a margin account, then you invest in a diversified portfolio. Basically, the only point I want to make here, because we've covered a lot of the other issues, is most owners who are thinking about an ESOP, in our experience, have really been thinking about it for probably 12 to 18 months before they actually do something. So it's never too soon to start learning. If you're thinking about doing it, don't figure that you have to do it next week or next month or this year.
Great. Thank you, Terry.
Sure.
Okay, so now let me switch the vantage point a little bit. I want to talk about the sort of the psychology of ownership and what this means for most companies in terms of what goes on within the four walls when employees have become part owners of companies. The first distinction I want to make is between what we might call direct legal ownership and a second distinction of indirect beneficial ownership. As Terry described, an ESOP is a form of the second. It's indirect beneficial ownership. In the eyes of the law, it is technically a form of a benefit plan, and so it's beneficial ownership. There is a legal trustee that has to be part of the picture here from the federal government's standpoint to make sure all the laws and regulations are being followed. If the beneficial indirect owner, the ESOP owns 100% of the stock, then we have a particularly interesting question. There's no distinction between the direct ownership and the indirect ownership, and the sort of expectation is that companies need to have thought through how they're communicating and how they're governing themselves, because the first question that the average employee is going to have is, you're calling me a part owner of a company, and I am a part owner, but there are some qualifications to that. And in fact, there are qualifications. But whether you are a direct owner or an indirect owner through this trust, the psychology of these companies in this situation, and the evidence is really pretty clear, that people are drawn to this idea of ownership. They want to think of themselves as owners. And the challenge over time is to figure out how rationally, in a step-by-step process guided by education, you can get people more involved and feeling excited about coming to work and feeling like a partner in a company. So the standard employment deal that we learned coming out of high school is that you do 8 hours of work for 8 hours of pay. What's different in an employee-owned environment? The new deal is that for your good work and imagination and effort as an employee owner, you're putting in new ideas and effort, you're going to get something different than just that paycheck. You're getting paid twice. You're getting paid through the paycheck, and you're going to be paid eventually when you're paid out as an owner of a firm. That's a big difference. And one is hoping for a virtuous circle, as we talk about it here, in terms of the average employee thinking of him or herself as an owner, has ideas about how to improve the company, how to improve his or her department. That comes back to them eventually through stock value. The education challenge. This is something, again, that takes time, and there's a planning process that really is called for here. This is an entire menu that we're not going to get into details of, about how to sort of chunk out the task of creating an ownership culture. That's really that's essentially where we're trying to get here in the longer term, is to get people to think like owners. Well, that involves opening up, being more transparent about information, making sure people first understand what the facts of ownership are, that they gradually acquire more skills to be able to assess financial and technical information, that they understand what's going on in their company, that they learn to talk to each other that management and workers learn to talk to each other about what it means to be an owner. That's the ownership values category. And I talk a lot and have curriculum that goes into detail here about getting people to talk to each other and to understand that for every right of ownership you imagine you might have, and rights are very prominent in our notions of property and ownership, there's a corresponding responsibility. So for every sort of time you might think you should have some say over a matter, there's a corresponding responsibility that you have the expertise to be the decision maker in that particular case. And there's a process here we'll get into in a minute about figuring out how to talk about that. There's also work that needs to be done at a sort of structural level to see are there mechanisms, are there committees, are there task forces, are there ways of getting people involved to be able to activate their ownership psychology. Corey Rosen, whose name has been mentioned, one of the legends in this field. Michael Keeling from the ESOP Association is another here in DC. Corey makes this quote is a powerful one to me. It's employee involvement, which is a key to getting people to actually act like owners and to engage them in new activities where they can show their ownership interest. It happens not because you allow it as management, but because you structure it. So that's a challenge to management in some sense, is to say you don't expect people to be able to walk in the day after their ESOP and to figure out how to be able to exercise their new interest. That's a process that's going to take time. This next series of slides I'm going to go through very quickly. There's a training product called Frontiers and Boundaries, Managing Ownership Expectations on the Ownership Associates website that you can find much more illustration here. But when talking about participation, it really comes down to being clear about who gets to make what decision. And the first message to give here is that we want the right people who are trained, who've got the professional training to make the decision. Employee ownership doesn't mean consensus decision-making over every issue. But it should mean something different than the standard model. And if this is the standard model that we have come to expect, that there are three groups, management, a board, and shareholders, then the question is there something better than this? And this model here, it's a lot of color, a lot of detail, people can study this on their own time, is purely suggested. There's nothing regulatory here. This is an advanced way in which some companies have figured out, okay, how do we protect management to do the things they want to do, that they're trained to do, and push more responsibility for the execution of the day-to-day work to task forces, to collective bargaining, to work teams. This is just a way of thinking about this. Now, I think we're going to switch now to get into some questions, but I just would want to make the last point, is that what this is really, what these sort of slides are raising are questions of corporate governance, and that is the news there is that the Congress, in their wisdom here actually, set a very low bar about what companies have to do by way of this sort of employee involvement. But it is completely discretionary for companies to do more than that. And maybe we can get into talking more about it. So, Cindy, it's over to you.
Yeah, thank you very much. Yeah,
Sure.
thank you, the
Sure.
two of you, for such an informative lesson on such an important topic to our members, for sure. I've assembled just a few questions that I think are commonly asked. I just wanted to get you to answer a few for our audience today. So let me start with the first question. The first question here is, how long does it take to implement an ESOP?
Terry, you want to take that?
Well, I would, just a realistic range probably would be somewhere in the 3 to 6 month, from start to finish, from the feasibility piece, getting the financing in place to actually closing a transaction, having the ESOP document adopted. It can take longer.
Right.
It can be shortened if there's a real need to do it, but I think that's a reasonable timetable.
Okay,
Yeah.
good. Our second question here, what are the professional specialties needed to get through the ESOP process?
Okay, well, I'll start with this, and Terry can supplement. Sure. There is a team of professionals that is generally necessary to make this happen. The first question is a question of feasibility. Is your company in the right kind of financial condition to be able to take on debt, to be able to service that debt compared to what else you're doing? How does this fit into your general strategic plan? What is your senior management? How does your senior management understand this? There's a process of feasibility analysis that needs to go on, and there's a related process in terms of feasibility to getting the financing necessary to make these transactions happen. And that's actually where my partners at American Working Capital are one of several resources around the country that can help with that. So feasibility and financing is probably the first. Second is legal specialty. Obviously, we've got a great lawyer here, and Terry Jones, and there's a community of ESOP lawyers around the country. There's a lot of law and regulation that needs to be understood here. They need to come in. Terry has mentioned trustees.
Can I just interject?
Sure.
You know, we normally don't like to come in until the decision on feasibility has really been made.
Right.
You know, you can't hire lawyers for nothing. So, you know, if the owner decides based upon Chris's work that it's not feasible or not the right situation for an ESOP, then chances are we won't be engaged. But if that decision has been made, if the board's looked at it, if the owners looked at it and they say, yeah, this really does fit, you know, then someone like us would come in.
Right.
Okay.
And then the third specialty is with the trustee specialty, and this this kind of connects to the corporate governance discussion for a second. So you got to go off the. Is that in many companies, I assume the companies that might be watching this, there's a question of whether you have independent boards of directors in the first place. Some companies don't. We think it is a good practice to have a board of directors of a firm like this, and because the selling shareholder is not in a position to make all the decisions him or herself, and in fact the law, and Terry will color in here a little bit, requires this role of a trustee whose job is to make sure that the beneficiaries, the employees, are getting the best deal possible, are being treated fairly, and the rules are being followed, that the valuation, which is the next specialty to talk about, the appraised value of what the shares are worth, has been done in a professional way and that is accurate. It's the trustee that accepts the valuation, the appraisal. That's a very important role, and it's one that is connected to this notion of corporate governance. Do you want to fill in a little bit about that?
And you know, the trustee, remember, the trustee is acting as the shareholder of the shares that are in the ESOP. So, you know, it's a direct ownership, but it's at the shareholder level, not the board level, not the managerial level in terms of what the control is. But they are subject to very strict legal requirements in terms of how they operate. Therefore, you know, one of the things that we typically suggest is, if possible, get an independent outside trustee who's not going to be subject to conflicts.
Sure.
And whether they're perceived or just perceived conflicts or real conflicts.
Right. So there's a community of independent trustees associated with banks and so forth that perform those functions. In very small companies, some people have officers of the company serve in that function.
And there are a lot of inside trustee ESOPs.
Right.
And then the trustee, the next member of the team is the trustee has to have its own counsel.
Right.
Okay.
So to continue the specialty list, I mentioned valuation. These are generally closely held, privately held businesses. How do you know what the stock is worth? You can't go to your newspaper and check on stock prices. There's a professional specialty of appraisers, of valuation firms. That is, in fact, a lot of what the initial feasibility effort is about, is to give an estimate about what the value is worth. The seller will have an idea of what that's worth, but there has to be, if a transaction is going to happen, a valuation firm needs to be retained by the trustee to determine what the price of the shares is going to be. So that's a very important specialty. Then last two are sort of a little bit first on the compliance side. There's third-party administrators have to be hired, like you have from your 401k industry stuff, to get out to get out account statements to people, to get out the rules, the summary plan descriptions of what things are. And then finally, there's no requirement on this, but it's implied in a lot of what we're talking about. There's a cost associated with education and communication about what ownership means that is a specialty that needs to work in this space.
Very good. Yeah, so quite a large
It's a
team.
team effort,
Yeah,
really.
very much. And my final question is, what would be an appropriate corporate governance structure?
Right. You want to start with that, Terry?
Well, I would start first of all just reiterating what Chris said about a real active operating board with outside board members. And that's one of those things, in that 18-month period when the owners are starting to think about an ESOP, that's one of the things they really ought to start to look at is how is the company run? We need to run it like a real company if we're going to have some give some thought to doing an ESOP. So I think that's the first.
Yeah, and just a couple words on that. I mean, the role of a board is to help a company grow, and so you want professionals on that board who can solve problems, who know the market, who can figure out how to grow things. Over time, in particular, if you've got particularly 100% employee-owned firms, employees are going to have an interest in who serves on that board because that board is a governing body of the corporation that they are part owners of. It makes sense over time to consider employees potentially serving on that board in some sort of a minority capacity usually. Oftentimes it's even a better idea for employees to have a say in picking some of the outside professionals that might sit on that board, people who the employees have vetted through some sort of an interview process themselves, so that people really feel that they have a say. But at the end of the day, the last message to make on this, Cindy, is that employee ownership, ESOP companies continue to believe in the division of labor and continue to believe that experts, people who are trained, are the people who need to make decisions. But there also need to be the beginning of a journey, if you're going to create an ownership culture, of inviting people in to help make better decisions and to be able to go outside of just that 8 hours of pay and for 8 hours of work, and to come up with new ideas from all the way up and down an organization where people can exercise their ownership interest as part owners of a company.
Okay, very good. Yes, so this pretty much concludes our session today. I really appreciate the two of you visiting with us today.
Thank you.
So Dr. Mackin and Mr. Jones, thank you very much for addressing our members. This concludes our webcast on selling your business to your employees, employee stock ownership plans as a succession strategy for business owners. This webcast is part of the Impact Webcast series on growing a business. Please tune in to additional Impact webcasts, which can be located on our website. The address is www.impact-net.org.